Yesterday at this time, we were talking to a lot of guests who thought, well, it could be a better than expected number. The market could have a reaction to this because maybe if it shows any signs at all that inflation is coming down, the market will breathe a sigh of relief. But that was before we saw the really negative trade yesterday, down 2% on both the NASDAQ and the S&P 500, down more than 600 points for the Dow. All of that came at the end of the trading session. Jason, I guess the question is now, is there anything that would be an additional negative surprise to the markets, or do you think there is the potential for the markets to trade higher if there's any sign that maybe we've peaked, maybe things aren't getting much worse from here?
I think that there was sort of tissue rejection from having any risk going into this number. It's obviously one of the most talked about numbers over the last several months, if not the year. For us, what we're looking at is not just what does CPI look like, but you talked a lot about, potential consumer recession or slowdown. The honest truth is the consumer is very strong from a balance sheet perspective, but just like corporate America, what we're shifting from is, hey, what is the revenue line item to what does the balance sheet look like? Strong balance sheets are good. Strong revenue, or at least growing revenue, is no longer the only goal. So that's really going to be the story from an earnings perspective and from what equities are going to be able to do, not just today, but over the course of the next few months and year.
I see you've been looking at something called the Costanza trade, as in Seinfeld's Costanza, George Costanza. What is that?
It's another version of, buy the rumor, sell the fact. A lot of times what you're getting is good news is good news. But right now, a lot of things that you're seeing is good news is bad news with regard to the Fed. Everyone is focused on the Fed, reasonably so. They're very far behind. So when you see really strong economic news, what that means is the Fed has to keep going. Arguably, this is a Fed that has wanted inflation for a very long time to be higher than it is. So, quote unquote, good news would have been high inflation. Now it's not such good news, right? A strong either nominal or real economy that's driving inflation, and certainly supply chain or demand problems from a damaged supply chain is really bad news for the market. So yeah, we're in the Costanza trade, so we'll see what happens.
It's a little weird to think that the market is potentially rooting for bad news. I don't know if they're getting it right, because if the Fed is serious about fighting inflation, you should be looking for inflation to come down. Bad economic news overall doesn't necessarily mean the Fed is going to go more cautiously. If they are serious about what they've been saying, what Jay Powell has been saying is that inflation is job number one. We will deal with this come hell or high water.
I completely agree. The Fed is in the worst possible position for a set of government officials, which is that they're embarrassed. They made a mistake. Yellen has admitted that, although she obviously wasn't on the Fed for this set of decisions. And look, these are smart people. They work hard. There's no sort of malfeasance here. But what they're doing is saying, hey, look, we got to catch up. And I agree. I would rather have the Fed be credible than the Fed be soft in this case, because if the Fed loses credibility, we'll have much, much more volatility than even we've seen so far.
There are all these questions about when the consumer is going to roll over. It's been such a strong consumer for such a long time, but you'd expect financials to be doing well in this environment with the Fed raising rates, but these concerns about whether the consumer is going to have troubled times ahead has some people staying away from those stocks. I think it's interesting that some of your favorite stocks are Capital One Financial, Visa, and JP Morgan. Why?
We look at the balance sheet of the consumer, and it's really stronger than it's been in some time. Now, the consumer started to dissave and therefore actually use some of these services, right? There's actually increased borrowing and credit card spending. But there is such a strong balance sheet here that I don't view this as sort of a redux, certainly of 2008, when the consumer was way, way too over-levered. So what you see is an environment where any kind of recession or downturn could be a consumer spending slowdown, but not a consumer balance sheet recession. And I think that gives us a lot of confidence to include looking at some of the remittances for the fixed income that we own and looking at a lot of the reports from the financials that we own. There is some stress further down in the subprime consumer, but actually you really have to dig deep in that area to see any real stress so far. So it's a relatively strong balance sheet, and both from the companies and from the consumers, and that's what gives us confidence.